But when it comes to the unemployment rate being low, the reason that recessions generally happen during periods of time where there's a lot of unemployed people is because the GDP is 70% consumer spending. And clearly, consumers spend less money when they're unemployed than when they are employed. Now, there's one exception, the COVID recession, because the unemployed actually had more money than they had when they were working because of the asinine policy of paying people more unemployment benefits than they earned in salary, because you created an incentive for people not to want to work, to collect more money by being on vacation. And so they were spending less time working, which gave them more time to go shopping. So spending really went up during that COVID recession, which was problematic. But typically in a recession, when people are unemployed, they watch their money, they cut back, because their unemployment benefits are less than their paycheck. And so they have to make do with less. And since not a lot of Americans have a lot of savings for, a rainy day, they have to cut back. And when you look at a low unemployment rate, people assumed, well, no one's going to cut back on spending when jobs are so plentiful, right? So why would it be in a recession? What people were overlooking, and I pointed this out in a prior podcast, was the big increase in the cost of living that resulted from inflation was effectively giving everybody a pay cut. So even though they weren't getting a pink slip, they weren't getting a complete elimination of their paycheck, the real buying power of their paycheck was being diminished. And so yes, everybody still had jobs, but everybody had a pay cut. So everybody had to cut back on their discretionary spending because they were spending more of their pay on rent, on food, energy, insurance, stuff like that. They had less money left over. So effectively, it was like having a big increase in the unemployment rate, because as people lose their jobs, well, they spend less. But if everybody gets a pay cut, they also spend less. So I pointed out that in this dynamic with high inflation, you can certainly have a recession with low unemployment. And that is in fact where we are if the data confirms the current projection from the Atlanta Fed. But a point that everybody has to start pondering is, if we're already in recession with low unemployment, think about how much worse the recession that we're already in is going to be once the unemployment rate goes up, because it's going to go up. Because a lot of these businesses that were optimistic about the future are now becoming a lot more pessimistic, and they're realizing they overhired. They have a lot of workers. They don't need, in fact, even Facebook was making comments on Friday about a lot of layoffs that they see coming. Zuckerberg was talking about a massive recession. He's very negative on the economy, and he thinks there's a lot of layoffs coming. So if Facebook is laying off people, you know that layoffs are going to be widespread. So as we get a big increase in unemployment, the recession that we're already in is going to get much worse, because now you're going to have people who lose their jobs who are going to really have to cut back on spending. But even the people that still have their jobs, well, they have to cut back too, because they're going to continue to get their pay eroded by inflation, because inflation is not going to go away just because we enter recession. Inflation is going to stay here. And if the Fed continues to raise rates, people are still going to be confronted with higher interest payments as well as higher consumer prices. And many of those people are going to be unemployed. So they're going to have less income as their cost of living is going up, and the unemployment benefits are going to be inadequate. So this is going to be a massive recession, and we haven't even seen the bankruptcies, the foreclosures that are going to result in a recession where revenues are less than expected, but with higher interest rates, your costs of servicing your debt is higher than expected. And this is for everybody, private sector, government sector, everybody is going to be confronted. The US government in a recession, they're going to see their tax revenues go down. At the same time, their interest expense is going up on paying the interest payments on the national debt. And also they now have a larger deficit to finance, not only again because their tax revenues are depleting, but they're spending more money on the automatic stabilizers that kick in a recession, more food stamps, more unemployment. So the deficit is going to explode. And this is not just a garden variety recession. I mean, even the people who are acknowledging that we might be in a recession, they say, well, it's going to be a mild recession. Mild? Where would you get any indication that the recession that we're in is mild? Recessions are typically proportionate to the booms that precede them, right? You get a bust that is proportionate to the boom. Well, we've had the biggest boom ever in terms of artificially low interest rates, causing all sorts of malinvestments and misallocations and mistakes being made. Remember, the 2008 financial crisis resulted from the Fed moving interest rates down to 1%. They were there for, 1.5, 2 years, and then it took another 1.5 years or so to get back up to 5%. And during that time, that 3 or 4 years where interest rates were artificially low, we inflated this massive housing bubble that popped and gave us the financial crisis. Well, we have now had interest rates at virtually zero for the last 12 years. I mean, we've had a few years where they were above zero, but barely. And in fact, even the years we were above zero, we were still below the 1%, which was the lowest we got after the dot-com bubble popped, and that inflated the housing bubble. So if the mistakes that were made with 1% interest rates for a couple of years caused the worst recession since the Great Depression, imagine the mistakes that have been made during this 12 years of zero. And so this is going to be a financial crisis. This is going to be a depression, not just a Great Recession, unless the Federal Reserve changes course. Now, of course, if they change course, if they pivot, if they go from inflation fighting to recession fighting, it's ultimately going to get much worse. This is just a situation where you're trading a short-term pain for even worse long-term pain. But that is the decision that the Federal Reserve has made every time since they were confronted, other than Paul Volcker. And again, remember, what Powell said he admires about Paul Volcker is not the fact that he jacked up rates and caused a recession. It's only that he did what he thought was right. Well, I think in these circumstances, given a similar choice, only more dire consequences, I think what Powell thinks is right is going to be the opposite of what Volcker did, and he's going to go back to rate cuts and back to quantitative easing. And in fact, I wanted to go over just some of the economic data that came out this week that led to this -1 forecast for the Atlanta Fed for Q2 GDP. We got the Dallas Fed Manufacturing Survey for June. That was -7.3 in May, and it ended up at -17.7 in June, so a big drop. The production index was at 18.8 in May, and it sank all the way down to 2.3. The trade deficit for goods in April also came in wider than expected. They were looking for -102 billion. We got -104.3 billion. We also had an upward revision to the prior month from 105.9 billion to 106.7 billion. Imports actually dropped 0.1 on the month. And remember, these are not adjusted for inflation. So with prices higher, obviously a big drop in imports because Americans are in a recession. They're broke. They can't afford the products, the higher priced products. And so they're buying fewer. Our exports were up, but barely, up just 1.2%. But because our imports are so much bigger than our exports, you didn't really see that in the number. Then consumer confidence, this is another measure of sentiment. It was supposed to come out at 101. Instead, it came out at 98.7. And the prior month, which initially was reported at 106.4, they revised that down to 103.2. Richmond Fed Manufacturing for June, the prior month was -9. They were expecting +2. We got -19. That was lower than the lowest estimate. The estimates were from -15 to +5. Then we also got the numbers for personal income and spending. Personal income was supposed to rise by 0.5, and it did rise by 0.5. In fact, here they actually revised up the prior month from 0.4 to 0.5, but it was the spending number that disappointed. People were looking for an increase of 0.5%. Instead, spending only went up by 0.2%. And in fact, they revised the prior month, which was originally reported as up 0.9% to only up 0.6%. So consumers spending less big part of GDP that's also driving the downward revisions. Now, the markets were a little bit excited about the supposed good news with the inflation numbers. The core PCE month over month only went up 0.6 when they were looking for 0.7, but that was a big jump over the 0.2 from the prior month. The year over year number rose by 6.3. They were looking for 6.5, so that was a little bit better. The core PCE was only up 0.3 as opposed to up 0.4, but that's still, annualize that out, it's a big number. And the core year over year was up 4.7, which was supposed to be 4.8, and it's down from the 4.9 from the prior month. So some people are like, oh, see, inflation is easing up. Look, you're always going to get some months where inflation comes down. In fact, I do expect there to be some months where you see bigger declines in prices or smaller increases, because one of the things that happens early on in a recession is a lot of companies go out of business and they start liquidating their inventory, right? They have sales, going out of business sales, worst case scenario. And so there's price markdowns as they're trying to clear out shelves that have too much merchandise. And so that might temporarily impact the numbers. But once they liquidate the inventory, prices are really going to shoot up because the cost of replenishing it is really going to go up. I think a lot of these companies are making a mistake if they do a fire sale on their inventory because they want to replace it with new products, because then they're going to be in the same predicament. They're going to have a bunch of new products that consumers can't afford, and those products might be even more expensive than the stuff they can't afford to buy now. I think it would be better for companies to hold on to that inventory and just stop buying and sell what they have, and maybe sell it more slowly, but try to sell it at a better price point rather than sell it at a loss and then buy new stuff at full price and ultimately be forced to sell that at an even bigger loss. But you're going to see some temporary relief, and it's going to lead some people to think, oh, the worst is over, inflation is over, and the next thing you know, it's going to come roaring back and it's going to make new highs. But finally, we also got the Chicago PMI number for June. That was supposed to be 58.4, which would have been a decline from 60.3 in the prior month, and instead we declined all the way down to 56.